All right, so like Ryan said, I'm covering ARM Holdings, symbol ARM or ARM on the NADSAQ. It currently trades at roughly $56 after IPOing at 51 last week. It's very volatile right now, so probably by the time you're watching it, it could be $5 or $10 difference. It would not be surprising. That $51, though, which it was expected to IPO at, it was already their high end of their range, and it's trading above that now. But ARM is a designer of computer chips intended to run on a battery. ARM compute platforms are the most power efficient on the planet and continue to push the thresholds of performance to enable the next generation of smart, AI capable, visually immersive, and increasingly autonomous experience on everything from the tiniest sensors to the smartphones, to the automobile, and to the data center. ARM designed, or at least partially designed, components as they license out some of their tools, and as well as manufacturers such as Apple that will heavily change the underlying software, well, design, I should say, not software, is in 99% of smartphones. So effectively, if you have a smartphone, ARM is at least designed a portion of the chips inside. The key difference to them compared to other semiconductors such as Intel or AMD is they design on the RISC-V architecture, which is significantly different from the x86 architecture, which they use, as it is significantly more power efficient, and that's really their main selling point. Before we get into the financials, though, let's just take a look back at its road to its effectively second IPO. ARM was previously a public company. ARM was taken private by SoftBank in 2016 for an acquisition price of $32 billion, which was a 43% premium at the time, after it traded on the London exchange and as well as the NASDAQ for about 20 years. Then in 2020, NVIDIA announced it was looking to acquire ARM, but it was effectively blocked by regulators, ending discussions in 2022, and they were looking to acquire the company for about $40 billion. Now, for its current IPO, the company was valued at $54.5 billion and is now trading at just under $60 billion. During that period, revenue increased from $1.56 billion in 2015, prior to being taken private, to now $2.7 billion in first fiscal 2023, a CAGR of about 7.1%. Moving to the current financials, we don't have the same granularity as we do for other companies, as they didn't previously report their quarterly earnings, of course, since they weren't a public company. So as far as quarterly earnings, we only have the fiscal Q1 2024 and Q1 23 numbers, as well as the annual fiscal 2022, 2021, and 2023 annual results in its prospectus. During its first quarter of fiscal 2024, the company had revenue of $675 million, down from $692 million in the prior year, so slightly lower. Similarly, for the revenue for fiscal 2023, which was effectively flat at $2.7 billion, but that was a large jump up from $2 billion revenue in 2021. As well, the company only designs and licenses architecture and its tools, so it has a great gross profit margin of 95.4% for the quarter, a key difference compared to other semiconductor companies, and that is actually quite appealing, of course. Net income of 105 versus 225 million, or 10 cents versus 22 cents per share for the first quarter. Notably, this is lower due to increased research and development costs as well as SG&A. The increase in expenses was almost entirely due to share-based compensation, though. This isn't really uncommon for just before an IPO or just after an IPO, because people are wanting to really cash out their holdings in the company. You'll have aggressive share compensation beforehand. So it's not exactly surprising there. Share compensation, just to give you an idea, increased to 158 million from 13 million in the quarter year over year. So clearly they were ramping up share compensation. Additionally, like I was saying, the IPO, it accelerated the company's restricted stock unit plan, causing the pro forma IPO to have a lower net income in the last quarter of 100 million versus the 105, and significantly lower in the fiscal 23 net income from 524 to the current to 141 million, or 51 cents per share to 14 cents per share. These share changes are really just a one-off, but likely you're going to see analysts in future quarters adjust that out because it is a one-time thing, and you're not going to see that because obvious. Well, maybe in their case, actually, I should say they've already IPO'd twice. Maybe they'll do it a third time, but you're likely going to see that being adjusted out. So if you're seeing why they only have 14 cents now, that'd be why. Moving on to its balance sheet and cash flows, ARM has a strong net cash position of 1.8 billion, including their leases. ARM did have an operating cash flow deficit, however, for the quarter versus a deficit of 231 million in the prior year. But this is just largely due to accrued compensation benefits in both years being paid out during the quarter. So looking at the trailing 12 months instead, they did have positive cash flows of 856 million. So the quarterly deficit is really just a result of timing of payments and benefits as a whole. So the company is really cash flow positive when you're looking at a longer time period, and this is the same for the previous years that have been provided. However, ARM's valuations clock in very high. It has a trailing price to sales of 22 times and a trailing PE of 143 times, which at that point is effectively meaningless to say the least. Similarly, though, price to cash flow is still 67 times, which is very high. So, our take. Like many IPOs, the price came in hot, immediately trading above the already initially high end of the range of what was expected for the IPO. The company does offer a unique product. It has great gross margins, like I said before, as it is running a unique service, and it is very widespread, as I said, with the 99% in your smartphone, as well as a ton of other technologies and pretty much any small form factor electronic. If it has a processor in it, will likely be designed by ARM in some manner. But the major issue with ARM is it just has extreme valuations. Even ignoring the PE due to the quirks of share compensation, the price of sales is high, the price of cash flow is high, especially given the weak macro backdrop that we've seen for the industry for the past about year or so. And we don't really know when that's exactly going to pick up. So you could still be waiting another 1 or 2 years before you start to see that cyclicality start to trickle on up in the semiconductor business. So you're really playing a waiting game at these high multiples as well. And as well, the return to growth the growth during the time it being private wasn't that great. 7.1% at a 67% cash flow multiple. That's not very good. You're expecting high growth when you're paying these extreme premium multiples. So just as overall, ARM just needs to be significantly cheaper to make it appealing.
Yeah, I think it's pretty straightforward in terms of valuations. It just, if you're paying those multiples, I think we'd like to see great growth. I mean, the margins look, good, but the growth in terms, growth isn't there to justify the multiples right now for us.
It might make sense to look at some research on IPOs because the general consensus from what I've seen is that obviously some IPOs can do well, but typically companies don't IPO unless they're getting a premium valuation. And so generally it tends to happen at the peak of the market or close to, or the peak of maybe a particular industry. So it's generally speaking not a good way to invest, but I haven't really gone through the research. It'd be interesting. I mean, yeah, with ARM at those valuations at that growth rate, you can't even really consider it investable to us.
Yeah, just even looking at Nvidia 2 years ago, 40 billion, and now it's effectively 60 billion market cap, what you'd be paying right now. So 1.5 times the price for 1.5 years is trading significantly higher. And that was even on their acquisition price, which was probably already premium at that time.
Yeah. For us, if you keep buying companies with this profile, that multiple, the growth rate that isn't really there right now. I mean, they had negative revenue growth in the last year, did they not? And you can't justify those multiples. If you buy 15 to 25 stocks under that multiple and growth rate combination in your portfolio, we believe you're not going to do well over the long term. So that's why we don't add this company, even though, there may be some interesting technology there. You got to pay the right price.